Hello, I'm Elisa Zhang, and I'm a physician as well as a life and money coach. If you're thinking about using the short-term rental loophole in order to decrease your taxes this year, you better get a property under contract pretty soon. So what is the short-term rental loophole? Well, this is a way that you can use real estate losses to offset your earned income, and it doesn't require you to get what's called reps or real estate professional status. So this can be found in the tax code under regulation section 1.469-1TE3 2A. And this actually defines the definition of rental activity. And so from the IRS, with short-term rentals, the activity is treated like a business, and the taxpayer must materially participate if you want to deduct the losses. So there are 6 ways in which income for rental property can be excluded from the definition of rental activity and thus not automatically passive. So when it's passive, the losses can only go, passive losses can only offset passive gains. But when it's active, it can actually, your losses from the real estate can actually be applied towards W-2 or 1099 or what's considered earned income, which is active income. So those are, number 1, the average period of customer use for the property is 7 days or less. Number 2, the average period of the customer use of the property is 30 days or less, and significant personal services are provided by or on behalf of the owner of the property in connection with making the property available for use by customers. So this would include services like a hotel provides, such as daily cleaning or meals. Number 3, extraordinary personal services are provided on behalf of the owner of the property in connection with making such property available for use by customers without regard to the average period of customer use. Number 4, the rental of such property is treated as incidental to a non-rental activity of the taxpayer. Number 5, the taxpayer customarily makes the property available during defined business hours for non-exclusive use by various customers. And number 6, the provision of the property for use in an activity conducted by partnership, S corporation, or joint venture in which the taxpayer owns an interest is not a rental activity. So what most people will try to do is actually buy a short-term rental towards the end of the year, which is right now, if you're watching this video soon after it appears. So you can either meet the material participation rules by working on the property for more than 100 hours and more than anyone else, or by using the material participation rule of substantially everything before the end of the year. So typically with a short-term rental, if you do materially everything, that's usually going to be quite a lot of work. So a lot of people usually will hire out things, especially the cleaning. But you can get 100 hours in before the end of the year, then that will still allow your cleaner to potentially do the cleaning, because cleaning for short-term rental, can take a few hours. I would say 3 to 5 hours in general to turn over a short-term rental. So if you only have 5 different guests renting the property, well, 5 times 5 is still only 25 hours, so that would be a much less than the 100 hours. So then, what particularly happens, you purchase the property, you want to be able to put in those 100 hours. So that could be cleaning the property, getting it ready to be a short-term rental, buying all the furniture that you need for the short-term rental and placing the furniture in the property, building out the furniture, buying all the, pots and pans and things for the kitchen. So there's a lot to do when you set up a short-term rental, and it can easily take 100 hours. Even if you buy a property that has been used as a short-term rental, you can certainly spend the time, cleaning, changing furniture, putting in new decorations, working on the lawn or landscaping. Anything that you're doing to materially work on the property would count for those 100 hours. So if you get those 100 hours in so that you have the material participation, and then the next step, of course, is that you have to have guests. So typically what people will do is for short-term rental is that number 1 definition of the average period of customer use for the property, 7 days or less. So you want to get, if typically we'll say at least 2 different guests so that it's an average, because really don't average 1, but you can average 2 guests and get 2 guests to stay for 7 days or less. And then that meets the criteria for a short-term rental, and that's now not automatically passive rental. That can be an active rental. And now if you add bonus depreciation on top of that, that's really a paper loss, right? Because the point of investing in real estate is really to make money. In this case, in your first year, you can actually do bonus depreciation if you do a cost segregation study. So you get the cost segregation study, and let's say on a $1 million property, you could potentially get, gosh, I'm trying to think, maybe you could get 30%, so $300,000 kind of written off of compared to your active income. So if you have W-2 income of $300,000 and you get bonus depreciation of $300,000, then now your federal tax liability is on $0. So you could actually wipe out having to pay federal income tax on your W-2 income by using this strategy. So I hope that all makes sense. Of course, you want to talk to your CPA before you do anything, to just make sure that everything you do kind of matches what your CPA's interpretation of the tax law is. But this is an incredible way for you to be able to actually decrease your tax burden from your earned income by doing the short-term rental. Now, 2022 is the last year for 100% bonus depreciation. In 2023, it'll go down 80% and then decrease 20% a year until it gets phased out. So there's still regular depreciation even after it gets phased out. So that is one of the great things about rental properties, but having that bonus depreciation really allows you to have a huge amount of loss in the 1 year that you do the material participation and now write that loss against your earned income. And so this is a super powerful tool. I used it last year, and if that's something you want to do, you really want to try to get a property under contract soon so that you can put your 100 hours in, get some guests before the end of the year. Luckily, we do have holidays at the end of the year, and a lot of times people do, take vacation. So get someone in for the, Christmas time, and you don't want to necessarily just depend on New Year's weekend because that gets into the next year, but get in a second guest booking for December. So if you enjoyed this video, please subscribe to the YouTube channel so I can bring you more videos just like this, where I talk about all different topics on investing as well as money mindset. If you would like to actually spend some time and work with me in order to get some one-on-one attention so that you can actually put together a plan for building your wealth, I'd love to talk to you. You can always reach out to me at my website, growyourwealthymindset.com. On the website, you can sign up for a consultation call and we can discuss your situation, your financial goals, and make a plan for how to get you there. All right? Thanks for watching.